Good evening. Thank you so much for coming to our State of the Market 2021. I'd like to go ahead and introduce our speaker tonight, Andrew McNair, CEO and founder of Swan Capital.
As I was pedaling down the street, I looked backwards and there was no cars behind me. As I was pedaling, I saw the intersection with the stop sign and I went right through it and I looked both ways, no cars. As I continued to pedal, I couldn't see anyone on the sidewalks. I felt like all the businesses that I was passing by seemed like they were closed, preparing for the hurricane. I remember having conversations as I was riding my bicycle. I remember the conversations I had with my grandfather as he reminisced about how the Great Depression was. And I thought to myself as I looked at Natasha and I saw all these closed businesses, is this what it looks like? You probably all remember where you were on March of 2020. Because it was one of those times where you remember not only what you were doing, but you remember what you weren't doing. And so today, I want to unpack what happened in 2020 and talk about maybe where we're headed in 2021. Questions are not off limits. We're going to make sure we try to answer as many questions as we can at the end of this event, so please be sure to write it down. If you're thinking about it, someone else will too, is probably thinking about the same question, and I would really appreciate it if you ask that question so it could spread light on a certain topic if I don't cover it enough in detail. So, quick disclosure, I am giving you an update on, again, the state of the markets, but don't take it as personal financial advice to you. Right now, I can barely even see you because it's so bright up here. So let alone the advice that I give you one-on-one, of course, is going to be different to the person right next to you. But if you do have questions and some of the information alarms you or makes you feel positive, that's great. We can talk about that at a review. If you're not a client of Swan Capital and you're listening about it online, it's a perfect time to schedule a meeting to talk about it with me. So that's the quick disclosure. Don't take it as personal financial advice and run off with it. This is what Andrew said that night. We do have a really good set of agenda of items I want to cover for tonight, and I'm hoping to cover it in about 38 minutes. And we're going to cover these four main items. We're going to talk about what happened in 2020. We're going to talk about how stocks performed in 2020. We're going to talk about where we are now and potentially what the financial experts and analysts believe could be around the corner in 2021. So let's jump right into it. The year of 2020, which felt like the year of the 12 plagues. I don't know if y'all felt the same way, but I felt like there's something, again, right around the corner after one plague after another. So let's look at the analysts, the experts' opinions on January of 2020. And many of you were sitting right here 365 days ago, actually in the same building. And I showed this slide up here. And this slide is some of the greatest financial institutions in the world. They have access to all the information that exists that we know about, and they have some of the greatest financial minds working for them. And this was their estimate in January of 2020. And you can see they expected that the market would end at 3272. And wow, was it a completely different year than they expected. And again, these are predictions. This is what they were expecting to happen. No one expected a 30% drop in March just a few months after we actually had this presentation. But what occurred was what's called a black swan event. Now, swan, no intended. A black swan event is an actual financial term. That means it's an unforeseen event that blindsides the markets. And that's exactly what we saw happen with the markets in March. It was a perfect swan event example. And I had no idea in January, and many of you can attest to and witness what I said. I said, right there when I put that slide up in January 2020, I said, we are at the end of a bull run. And I said, all the economic indicators appear to be slowing down. And I wouldn't be surprised if we do see hiccups and pullbacks in 2020. I had no idea it was going to be a black swan event. I'm not a prophet by any means. But what you can see here is stranger than fiction. The market did not end at 3272. It ended at, as you can see, 3,700, a 16% increase for the year, even despite a global pandemic. It is truly stranger than fiction that we are farther along, if you're looking at just stock market evaluations, as if COVID had never happened, which is pretty interesting. So what actually drove this market performance? Well, we have this very fancy graph behind me. And to not make sure that our eyes don't glaze over, I really want to unpack this graph and go color by color. So I'm going to start with the blue, with the COVID-19 dots. So we saw that the market's reaction initially was, and even my reaction was, hey, global pandemics have happened throughout history. It's nothing to be alarmed about. We don't think it's going to be that serious. Well, we were a little wrong, and as you can see, it just kept on decreasing, especially when the economic lockdowns happened, companies closing their doors. None of that could have been expected. And I think what the markets and the analysts all really underestimated was a 24/7 media cycle. Social media giving real news as well as fake news that really compounded the situation. And as you can see, COVID started to get better and less of a market driver as we had hoped that there would be a vaccine that would give America, even if it's a placebo effect, this confidence boost. And then we saw in December fast-track FDA approval in December. Now, when we move on to monetary policy, we can see that monetary easing happened right after the market started to come to a screeching of a halt. And we'll unpack what they did, but the main two ones is they dropped interest rates from 0.25% to 0, which is unprecedented. And then they went on to do the CARES Act and enact the CARES Act was a $2 trillion, which is hard to even say, $2 trillion price tag to help supplement businesses and individuals. And as you can see, that did set the momentum for the economic recovery to continue. As we look at number 3, we see the economy and some of the economic drivers that I'm going to unpack. And then lastly, we have corporate earnings. Many people expected that corporate earnings would suffer dramatically. But again, what we underestimated was that many companies have subscription services, and there's this sales elasticity that people are still going to pay for their pest control, even despite if the market drops, if a business they frequent does close, they won't stop using their pest control services. So let's dive deeper into each one of these. The first was monetary easing. So the federal funds rate is really important, and here's why. By allowing more access to capital, banks are obviously able to free up more capital to give to businesses to take on more debt and grow faster. And what's really a scary trend, and we talked about this last year, I said, again, I'm glad it's not my job being, Fed Chair Jerome Powell, but it was really fascinating to see them lowering the federal funds rate because the economy was already starting to slow down in 2019. COVID was not even on the radar, and they kept on lowering the interest rate. And again, that was a sign for me because really the Fed, at the end of a long 10-year bull run, should have been increasing interest rates because they would have had a life preserver that they could have thrown out in a situation like a global pandemic. But the life preserver, and we talked about this in January of last year, was already out at sea, and they had never pulled it back in. And so we saw them take it from 0.25% to 0, which again is unprecedented, and you can't go much lower than 0. I believe that to be correct. If you look at the timeline, the Fed has really learned some lessons since 2008. In 2008, they kind of watched and waited to see how the financial crisis was going to work out. And when they should have started putting capital into the markets, they waited a little too long. Well, the Fed, at least Jerome Powell said, not on my watch. I don't want it to be a global depression on my watch. It can be on Janet Yellen's, but it's not going to be on mine. And so you can see all the timeline of events that happened. Like, again, interest rate cut, but then the asset repurchasing of $700 billion of asset purchases, which, again, just give confidence to the financial markets to continue to lend capital even despite businesses closing their doors. And then you saw them create these facilities that helped, for example, pay back and forgive the loans for the Paycheck Protection Act, or the PPP loans as they're referred to. And that, again, gives that confidence for business owners to say, hey, I'm not going to close my doors. I'm going to try it to go another 6 months. I'm going to take this PP loan and try to make sure I can, cover payroll. And it did work. But the underlying fear that I have is the Fed's response. I've always been a diehard free economic system believer that Adam Smith was right, that an invisible hand should not be slapped and should not be swayed. And that's not what we're seeing here. We believe, or at least we did believe, in a capitalistic system that believes that we should, make sure we help businesses, succeed, but not help them out. And here's the reason that I fear is this event, if it continues and everyone goes back to normal, businesses will never be the same. They will feel like they can take, even small businesses will feel like they're too small or too big to fail. And individuals are the same way, as if I know the government has this parachute of stimulus checks underneath me, then it allows me to take more risks. So again, it's not a political stance, it's an economic stance that we have to be careful of setting this precedence of these stimulus checks as well as the PP protection. This is the reason why small businesses and individuals have to have an emergency fund. And I think this is the biggest takeaway, is we don't have to have a global pandemic for people to realize that they need 6 months of savings, a year of savings, especially after a long 10-year bull run. I truly believe that businesses should have been prepared for a pullback like that. Just my personal opinion. All right, moving on to corporate earnings. As you can see, 2019, you can see that corporate earnings were already starting to slow down. When people refer to the market, it's this big term. I always like to pull back the curtain and say behind the market is individual companies. And behind those individual companies, if I don't fall off the stage, is going to be their revenues and their incomes. And that's why it's very important we look at this fancy chart here called a year-over-year sales chart. And it shows you the corporate earnings of 2019 was starting to slow down. So again, the market had low interest rates. The Fed was supporting them by lowering interest rates repetitively throughout the year, and still the market was slowing down. That should have been a sign. And then, again, a black swan event did occur, but a pullback was coming. And you can see that year-over-year sales is obviously down, and we do expect in 21 that it will start to recover, but even the analysts believe that it may be short-term recovery, because you can see it starting to slow down on the normal curve there. Wow, that chart, the economy, that'll make your eyes glaze over. When people refer to, I think the economy is great, or I think the economy is not doing well, I hope they're referring to these factors, these drivers of the economy. And so I want to take each slice, each row, and take it one at a time. GDP growth is something we all keep our eyes on when we're comparing countries' performance, economic performance, gross domestic product. And as you can see, in quarter one, the first quarter, we already were seeing it starting to slow down, in part because March is obviously in the first quarter, so it was starting to slow down. We saw a huge drop-off as the economy was retreating by the businesses that were closing their doors and were under lockdown. But then you see this quick rebound. And it doesn't take a math wizard to realize if we're 36% down and we come back 33%, we're still not back to even. Even with this 11% that we've seen in the last fourth quarter, we're still digging our way out of this economic recovery. Moving on to the labor market, we did have historically low unemployment prior to COVID. It was a really miraculous thing to see. Only 4% of people that were actively looking for jobs didn't have a job, and that is really great to see. Unfortunately, that didn't last, and we can see that unemployment rose to 11% and sometimes even higher during the second quarter. And then we did see a quick rebound in the third quarter. Nice to see that because of the monetary easing, that smoothed that out. But now we're starting to plateau with unemployment, and you've seen it on the news channels. How many hundreds of thousands of people claim, again, need more for jobless claims. So that number is plateauing. Inflation, it's no surprise that inflation remained low, because when you tell people, hey, I know you can barely make your rent check or your mortgage payment, but we're going to raise prices on you, people say, I don't think so. I'll either turn off the service, but we're definitely not going to increase the cost of our services. And so you can see inflation is staying very low. I'll skip over consumer confidence and go straight to manufacturing. I think all of us in this room, I know I did personally, as me and Natasha are building this house, is many suppliers in the manufacturing world said, you might never get this item. It's discontinued, or it'll take 6 months. And we saw that because of international trade coming to a halt. But where are we now? And one of the best visuals that I like to answer to you in a review, and you've seen some of these speedometers I'm going to pull up before, are these CNR speedometers. And this shows you December 2010. And I like showing you December 2010 because this is, again, 2 years after the financial crisis. We are in full-blown recovery mode, and you can see how many greens are on the board. Now, greens are headwinds. They're pushing the economy forward. And this is over, hopefully, a 3 to 6 month period that we're going to see the economy moving forward. But then we look at the yellow. These are the cautionary, still yet to be determined, if you will. And we saw that in housing. I know it's been, again, 10 years ago, but I remember when mortgages were not like anyone could go up and get one. It was hard to get a mortgage after 2008. Banks were very gun shy to lend money. And then we had geopolitical events, which have stayed continuous, I think, for the last 10 years. But you can see that December 2010, we were on a recovery path. These red speedometers are the brakes to the economy, slowing it down. So let's move on to January 2020. Again, I don't claim to be a prophet, but I looked at these speedometers with you last year and I said, there's a lot of yellow on this board. We saw corporate profits starting to slow down. We saw the yield curve was inverting, all the signs that a bull run was coming to the end. We had a couple great green speedometers up there, and then we had geopolitical events. I mean, can you even remember when we had trade tensions with China? It feels like 3 years ago, but it was only a year ago we were talking about all the China trade tensions, and that's why it was very red for geopolitical events. But as we move on, we look at where we are now. So where we are now is we have a lot more yellows, and I want to highlight some of the greens. So on the greens, you see monetary policy, you see fiscal policy, which is very coordinated with interest rates. So obviously interest rates are low. We have a Fed that is very supportive of the economic recovery continuing. And then we see the housing mortgages, obviously a result of the interest rates. People say there's cheap money and it's a good time to build a house or buy a house. And obviously those greens to me are not that green. Those are artificially inflated to be green. Equity market valuations are high. They weren't just yellow, now they're red. Again, and we see that with the market ending at 37.56. Many smarter men than I have said, and women have said we are inside the bubble because of the equity market valuations. Geopolitical risk, I think, is still not only an issue here, but I think it's an issue abroad. I think you're seeing so many countries really upset with how their own country has dealt with COVID. I want to zoom in on one of those speedometers called the leading economic indicator, or the LEI index. And it's really a combination of things like manufacturing. And it's a really interesting chart. It's just another data point. And I'm playing devil's advocate with myself because, as you can see, the recessions don't ever start when the LEI is on an uptick. So right now we're on an uptick here. Every time it's on an uptick, you don't see a big gray line here. So the LEI is telling us that they don't foresee another recession or a double dip. But these are, again, unprecedented times. It doesn't take much on a fragile economy, a fragile economic recovery, to throw us right back into a double dip. So you have two data points there, two different opinions. So let's dig deeper into some of these headwinds. So the first headwind that I definitely want to cover is COVID-19 vaccine and distribution. Again, talking about if it's right to take a vaccine, to take a vaccine is not what I'm going to tackle today. That is above my pay grade. So when it comes to the COVID-19 vaccine distribution, there is a lot of people looking at how many people are not only willing to take it, but the distribution. We've seen some states and counties that have struggled to have distribution in their community. And so that will continue to be a headwind pushing on the economy, because that is that confidence boost that is, for lack of better words, being injected, saying, hey, if we get everyone inoculated, COVID-19 will be a thing of the past and we can move on. But just from my own point of view, and again, you have your own lives to live and you have your own testimony or witness to a different account, but I was talking to a vendor of mine and we come in close contact many times. And I asked her, I said, are you going to get the COVID-19 vaccine? And she said, absolutely, I need to get it. And I said, that's great, you should do that if you feel comfortable doing that. And I said, but you're wearing a mask now, will you stop wearing a mask? And she said, no. And I said, so you're just going to wear it permanently? And she said, I don't know about permanently, but I don't know when. And that, to me, is a perfect transition to economic scarring. Economic scarring is not only for businesses, but for individuals. And I'll start with individuals. And my point with the vendor story, that's a real life story, is that if people have routines and habits that we've put into a rut in our lives, that we're used to staying at home and used to not now traveling abroad, we're only going to travel domestically, that is a huge effect on international markets that none of us can really abstract to what that's going to equate to. So economic scarring, that people are typically follow their own habits. And so I will be very anxious to see how quick people are to spend money to travel outside of the United States, who once were happy to do so, are not now. When it comes to businesses, economic scarring means that businesses like in the travel, hospitality sector, in the retail sector, yes, they still have their doors open, but their balance sheets are full of debt. And if your balance sheets are full of debt, how can you talk about hiring more employees, talk about growing into different markets? You're just trying to survive. And that's the economic scarring that, again, none of us know how that's going to play out. The other economic scarring that we can't see in corporate earnings, that fancy chart of year-over-year sales, remember all of those are public companies. They're not Main Street businesses. And those people don't report that they were going to open a new location, and instead they didn't. Number 3 is rising bond yields. Stocks are attractive because the 30-year treasury is at like 2%. Who wants to tie their money up for 30 years at 2%? That immediately, I know it sounds very simple transfer, but people say, well, if I don't want 2%, I'll go to the stock market because it's making 16% last year. And you think no one would immediately make that decision. You'd be surprised. People say, Andrew, you know, the stock market's going gangbusters. I can't make anything at the bank. I need to put my money in the stock market. That could be a real sign of trouble if rising bond yields actually do start to rise, because they can't go much more than 0, and they start going higher, then people will exit stocks and sell stocks. Last is the geopolitical events. We've already talked about that it's not only our country that's unhappy with politicians. I think it's a lot of different countries. Now, on the good news, there's a lot of tailwinds that could continue pushing the stock market forward. And these are great things. First and foremost is the COVID-19 vaccine. If people have this sense of confidence and they say, it's back to normal, I'm going to start doing my life a little bit differently. I will wear my mask, but I'm going to go out and spend money. I'm going to travel overseas. And we start to see people going back to normal. I think the quantitative easing may pay for itself. And that will be great, which is a good transition to what the Fed has done. And this is my biggest fear as an investor, if I was to be completely transparent to you, is yes, I have some fears, I would say, about market valuations being as high as they are, but to bet against the Fed is a bad idea. They have the capacity to tax everyone in this room and people that live in other countries that are American citizens. They have an incredible amount of power to tax us to pay back all the stimulus that they've poured out. So if they are, and again, Fed Jerome Powell has already stated that he will support, as long as inflation stays around 2%, continue pushing towards recovery. And Janet Yellen, we have yet to see her complete stance on that. Number 3 is health consumer. Obviously, in an economic recovery, typically we have a consumer that will spend more, and that equates to businesses having more profits. We know that consumers have a lot of excess cash. They've had a lot of excess cash on the sidelines for years, even prior to COVID, but with the stimulus checks, people are a lot of times sitting on those checks as well. And then the last is reduced trade tensions. Again, none of what I'm saying is political by any means. But when it comes to, there's 2 trains of thought here. Many believe, a lot of very smart experts and analysts believe that Biden will be tough on China, and he will believe that he will have agreements behind the scenes to talk over with our allies better trade agreements, and that is one opinion. And then there is another opinion that I don't believe as an opinion, as I do think it's historical. If you look at the last time he was in the White House as president, China was a superpower and continually grew to a stronger superpower in the period that they were in the White House. So again, I don't know what lies ahead, but a fear, if I do have fears to say that, that's a strong word to use the word fear, but it is China. This is a staggering number to say. 9 years, China will surpass our GDP. To me, that is astounding that they are the only positive GDP of 2020. No other country can say that they had a positive year other than China. And that was prior to COVID. We already knew they were a decade from catching up, but in 9 years, they're going to surpass us, which gives them a lot of power and a lot of weight. And again, I'm not trying to be very scary, but again, we are at this great time of the American Empire where gas is controlled in our currency, and that gives us a lot of weight to throw around internationally. But if it's measured in a digital currency or measured in a different currency altogether, that gives the power over to someone else. We've seen that if you study the English Empire, how it ended. It used to be all the trade that went from back and forth to the Atlantic was done in British sterling silver. So that is something to keep an eye on. So speaking of market evaluations, some of you have already seen me show this graph. This is the Schroeder PE. So when we go back to, you remember I said, what's behind a stock market? I said it's individual companies. What's behind an individual company is earnings and income. So to make this really tangible for you, I want to break down what the Schroeder PE is. An easy way to kind of understand it is if you were having a great cup of coffee at a bakery in downtown Pensacola or Mobile, and you said, these people are selling coffee like it's going out of style. They got to be making a lot of dough, pardon the pun. And they're making so much money, you say, ma'am, this is your bakery, right? And she said, yeah, I'm busy making coffee, but what's your question? You say, you're doing great. How much would you sell this coffee shop to me for? And she thinks about it. She's sweating over the cup of coffee that she's making. She says, you know what? We make $1 million a year. You got the right price. I'll give it to you for $35 million. You would say, excuse me, I'll just have the coffee and I'll take my receipt. There's no way that you would buy $1 million coffee shop for $35 million. Yet the S&P 500, the large U.S. companies, are selling at near 35 times earnings. You have Tesla, which, hate them or love them, they're selling at 1,600 times earnings. And maybe they take over the world, maybe they don't. But at 35 times earnings, I only can study history and tell you that bad things have happened after 30. Does that mean that this time is different? It certainly could. Look at the dot-com crash. This bubble, if we're in one, I can kind of see the film, if we're inside the bubble can go up for another 3 to 4 years. And the last thing I want you as a client to do is feel like you've been left behind, because that's not a good feeling either. Now, if you were in that stock market bubble of the dot-com crash and you jumped in, it was continuing to rise, and when it fell, you still had, if you were diversified, a really good return on your money. So I don't want to scare anybody, but anything above 30 hasn't proved well for history. So, around the corner, if we know where we are, we know where we've been, let's talk about maybe where we're headed. One economic indicator we haven't talked a lot about, I breezed over, was inflation. We saw that inflation was low for some items, for the general basket of goods. But if we start breaking out items, we saw that food went up 3.5%. That's because no one had anything to do but go to Publix and shop and buy groceries. And toilet paper was through the roof and a prized commodity. We actually saw in pink that oil prices and utilities had dropped 10%. And that's no surprise. They kept on pumping it at the oil rig. And what happened? Again, no one was driving. No one was flying their planes. And again, there was a lack of demand and an oversupply. Thus, the price drops. So we want to keep our eye on inflation. Now, when we have hyperinflation, which some of you remember in the 70s or 80s, hyperinflation is like fire. You don't have too much inflation, and hyperinflation was not good for our economy. And there are tools that the Fed can utilize to dial back hyperinflation. The problem is usually use that not during an economic recovery. So we have to be careful there. Deflation is not good either. It's a sign of economic weakness, so we don't want that. Moving on to unemployment. Again, a solid consumer, a healthy consumer, will spend money. And we have an economy that's built on spending money, especially here in the United States. And you can see that unemployment had skyrocketed from all-time lows, and it did rebound. And then we also keep our eye on the blue, and that is wage growth. We don't want a lot of people to have jobs, but that don't make a good income. That's no good either. So we want to see wage growth grow, not artificially, but we want to see it grow naturally over time. And we've been seeing wage growth, again, come up slowly. But we've seen it come up really high all of a sudden. And that is not something to celebrate. That is high-paying jobs coming back quicker than slow-paying jobs in travel, hospitality, and retail. So that is not a good sign. That means we have a workforce that needs to get educated quickly and go up to a higher-paying job. So these are the experts, the largest financial institutions that we have globally, and they have their predictions. And these are just that. They are predictions. But I will point out that, as you can see, all of these predictions are positive. They believe that the stock market will see another positive year. And if we have a Fed that is continually pushing the economy forward with an economic recovery, yes, you can do it. You can keep on spending our way into a hole and supporting the economy. No one knows how long that will last, though. I think what I really want to share with you as a summary line, and I hope all of y'all are taking notes. There's a test at the end of this, right? No, I'm just kidding. So this is the one message I really want to make sure you tune in, is this chart right here. This chart, I think, is a very educational piece because it shows you that even in a year, which is a great case study, is last year of 2020, the market can go up 16%, but have what's called an intra-year decline of negative 34%. You can see a lot of the positive years in the stock market had huge drops. And the sad part is if we watch all the big heads in the news, they will say, it's scary out there. And people will take short-term news and they'll make long-term decisions on their finances. And a long-term investor, if they were long-term throughout year 2020, saw a great return. Now, how long that return lasts and how much is pulled back, no one knows that. But we can see that more pain has happened to people that follow the intra-year declines. And some years, it's going to be negative, and it could be even worse. You remember 2008, the market ended at it was technically negative 37, 38%, but it went as low as 49%. But the person that stuck in there didn't lose as much. And so that's why it's very important, and we talk about this all the time, on having an actual financial plan. And that's why many of you will understand the analogy that I'm going to give you if you're a client. We have to be diversified in your roof accounts. The roof accounts are those accounts that are in the stock market. They are always going to go up and down. But if we know we're not going to touch them for 10 years, that gives us a permission slip to take risk with those roof accounts. But if you have a solid walls and foundation, which we utilize that all the time in our reviews, you know what a wall and foundation means to your family, that gives you that stability to know that your retirement will be okay and that you can spend money while others are a little hesitant. I do want to talk about some of our roof accounts and give you an update on our Swan portfolios. There's 4 Swan portfolios. We have dividend, we have balanced, we have growth, and we have aggressive. I'm very happy to report that when April happened, in March and April of last year, when we were starting to backpedal because of the state of the markets last year, I told y'all, I said, if you don't tell me otherwise, I'm going to start backpedaling. And I'm glad we did, because we were able to move 30% of clients' portfolios from dividend balanced to Swan growth and buying while everyone will be selling. And that is really the hope I give you, is that in our portfolios, we are prepared for pullbacks in the economy. And we will buy if it's long-term money. If it's money in your Roth that you're not going to touch for 10 years, I know that about your portfolio, and we can buy more while people are selling. So let's talk about our Swan Balanced. If you compare it to the S&P 500, which is a very hard competitor, it's made up of 500 large U.S. companies. It has no bonds. It's 500 large U.S. companies. And so our Balanced has small cap, mid-size, large. It has a little real estate in there. It is well blended and well diversified. And we are prepared for, again, another 2008 if one is on the horizon. As you can see, if another 2008 happens, we're ready for it. Yes, your money will drop, but we have bonds that we can convert to stocks to buy, which is great. A couple of things I want to update you on is on the Balanced fund. We actually rebalanced quite recently, took some of the bonds out and replaced them with a little bit of emerging market bonds, because other markets are improving faster than the United States, especially in emerging markets. So we wanted a higher bond yield there. The other thing we did is we had a lot of mid-cap growth. Anything with the word growth on it is overpriced right now. And so we're trying to be less concentrated into growth and more into value. If we look at Swan growth, that is a riskier portfolio. It will go just as far down as the stock market. But again, it is well diversified. And with Swan growth, I'm happy to report, again, I don't always bat 1,000, but we saw that oil was cheaper than water last April. And you saw this change last year where we bought 5% of VDE, Vanguard Energy, and we bought, again, oil while it was cheaper than water. And I think that's paid off. It went up, that holding was up 58% last time I checked. So I'm really glad that we made those moves. And remember that our portfolios are passive. We don't make many changes. Very rarely do we make changes, but we did see some opportunities. A couple things I want to share with you, especially for clients that are listening in, is that we're always trying to better your experience here. And I'm always looking for your feedback, both positive and negative, because we want to do better for you. And one of the ways that we've listened is some clients have said, hey, can we get some more in-depth reports? Can we have some simpler reports? And I hope with this new client portal that you're not only going to have new reports that are simpler, but also more in depth. You're also going to have your TD Ameritrade monthly statements and tax statements all uploaded into this new what's called Orion portal. And this portal is also really, really cool because it has a client vault. We can put your legal documents secured and encrypted in this client vault that you have access to and only you have access to. It'll have meeting notes in there. So I think that's a really cool feature. And then last, you can use this as little or as much as possible. You can connect other bank accounts, 401ks, if you're not yet retired, so you can see all of your investments in one shot. And we're working on that as an initiative for 2021. I have no deadlines on how long that will take to roll out. I have room for a few questions. I want to be very respectful of people's time tonight. So I see your hand. I don't see many other hands, but I see yours, Mr. Willard. Go ahead.
With the rising discussions with cryptocurrency,
Oh, man.
do you see that as an impact to my portfolio?
That is the second cryptocurrency question that I've received. What do you think about cryptocurrency? Again, obviously, hindsight's 2020. Cryptocurrency would have been a good thing to dabble in when it was 7,000, not 30+ thousand. I have an old school perspective on cryptocurrency, and it's not popular. It's very controversial, but I still haven't had anyone that ever really battled me on my logic here. So here's how it goes. For a little bit of your portfolio, if you want to sprinkle and play with it, if you want to do that instead of going to the casino, sure. But here's my challenge to you when it comes to cryptocurrencies. If I were to ask you, how does gold create more value? You would say, how does gold recreate more gold? Well, I can chip off a piece of the big block. You can do that, but is that creating more gold? No. All right, got it. So when I get to cryptocurrency, it's the same question. How does it create more value? Because the Winklevosses who didn't get the Facebook rights decide that it goes up in value, that's not good enough reason for me to adopt it. Also, it's not backed by anything. It is as fiat as the United States of America's currency is. It's not worth only but the paper and the promise to tax you. They can't do any of that. And if anything, the United States will get so jealous that they can't tax cryptocurrency, they will make it so. And if people say, especially people that believe very wholeheartedly in cryptocurrency, say they will never be able to tax it. And I say, don't be so sure. There was a time where they made gold illegal. So they can do a lot of different things. So does cryptocurrency have a future? I do think it has a future somewhere. Is it Bitcoin? I'm not sure. I do think if we saw a gold-backed, one that was gold-backed like our currency used to be, maybe that would take, but again, I have my reservations, I will say, of cryptocurrency. Any other questions? Go ahead, Mr. Roque.
I noticed on the slide when you're showing your things, that those are negative numbers. Why were those negative numbers? I thought they'd be positive numbers.
On the portfolios?
Yeah, if you went back before.
That was 2008. That's showing you if our portfolio, in the stock market of 2008, that's one of the worst economic periods, it went down, the S&P 500, 37%. Our portfolios, like the balance, went down 18%. So to me, that feels really good that we get half the market's losses, but it historically has kept up with the stock market. To me, that's a good portfolio. Thank you for your question. One more. Okay.
We talked about international trade, how it just stopped. Now, was that because of our arguments with international trade, or was that because of COVID or both?
Wow, that is hard to tackle. I will tell you personally, when I told people I flew south for the winter, they said, you mean like Miami? You mean like, no, I said, no, I went out of the country, and they're like, you can do that still? And so I'd make a joke out of it, but so many people don't even think we can leave the country. So when it comes to international trade, that complicates international trade when we don't know what restrictions are going to be made. So I think that was one in part because of COVID, and the other part would be politics, but I don't want to go down that route. So again, thank you for all your questions. Again, if you have questions, shoot me an email. That's what I'm here for, to help put some of your fears at bay. I hope you got a really balanced view today and tonight. I want to tell you what steps you can take. The first was what I was talking about. Shoot me an email. If you're worried about pulling all your money out of the stock market, I just told you that that hasn't fared well historically for people. Having a long-term approach has. And many times, if you think, I should pull all my money out of the market, we already have portfolios that will zig when the market zags, so you don't need to pull money out of the market. We already have portfolios, parts of your portfolio that are prepared for that. The second item is tell us about what's going on in your life. I care, and everyone else at Swan Capital cares about what goes on in your life. One, because we do truly care. And the second reason is I want to know because it impacts how much income you're going to be taking from your portfolios, from your accounts. And I want to be in on those big financial events and help you out where I can. And my big takeaway, looking over all of your portfolios this year, I do that every year at the first part of the year, is I want to encourage many of you to spend more money. The reality is it doesn't take a global pandemic to make us all realize that this life is our only shot. And we are all 100% terminal here, COVID or not. And you lost out on a year of life if you didn't go travel and do your hobbies. And so I want to encourage you to live courageously and go out and spend money. I'll tell you when you've just lost your mind and spending too much. Let me do that for you. And happy to do that. Number 3 is make sure your legal documents are up to date. I have heard so many people complain about COVID-19, but when I ask them the tough question like, is your will up to date? Did you go to the bank and make sure that you had POD and TOD on all your bank accounts? So many people are like, I was happy with my complaints, but now you're giving me homework. And so I don't want to see complaining. I want to use that as good positive energy to take action. So that's going to be our wrap up for the State of the Markets 2021. I do want to share with you some other items, but I'm going to have Josh stop the live streaming for a second and thank you for who's all listening to the recording today.